Gerald, good morning to you and welcome to AM
morning.
News.
Good morning, Elvis.
Tell us about the seminar first and foremost, and what are you hoping to achieve with it?
Well, what we're hoping to achieve is to have a discussion on the broader issue of financialization, how the financial sector relates with the real economy. I think this is a concept that has come to the fore in the past 30 years, as that relationship between finance and the real economy has changed. What has happened is that instead of the financial sector supporting the real economy to create surplus, the financial sector is now focused on creating surplus for itself. So we're going to be looking at how this kind of growth of the financial sector affects our economy.
Talk to me about industrialization and macroeconomic policies. How does it affect a company, or a country, rather?
Well, absolutely. I mean, if you look at South Africa's macro policy from the 80s, we started changing our macro policy in line with the Washington Consensus policies, which meant that we liberalized our economy. We basically opened our capital accounts. What the impact of that is that we are basically allowing firms and corporates to take out their capital into other places. And what we do is attract short-term inflows that are not good for investment. As well, with tightening monetary policy, what happened was that interest rates were increased, and then we attracted even more of these short-term flows that are not good for long-term investment. So if you look at after the end of apartheid, the new government chose to continue with this type of policy with GEAR and RDP. And what happened was that focus was taken away from industrial policy and industrialization, which led to the decimation of some of our key industries like the textile and clothing industry.
So basically what you are saying is that the investors would rather than get out the profits from the companies instead of reinvesting it in industrialization.
Absolutely. That's what we're looking at. What we're saying is that when firms continue to share out surpluses and invest in financial products, there's a negative impact, because instead of investing in long-term real investment, which will create jobs, they're putting it into the financial sector. We all know that the financial sector is one of the least creators of jobs in our economy, and one of the most unequal as well. So if we're going to fight unemployment and inequality, the financial sector, I don't think, is the sector that should be driving our economy.
Currently, how is the labor industry affecting the economy at the moment of the country?
Well, if you look at South Africa's labor sector in comparison with countries like China, when China industrialized 30, 40 years ago, the labor sector was completely different. Wages were very low. It was a very sort of stable environment, which was very good for investors. And it was easy to attract investors. Now, what South Africa is doing is they're trying to increase wages at the same time and bring down unemployment, which is very difficult. So it almost seems like putting the cart before the horse, because you'll be sitting in a place where you have very high wages and very high unemployment, which is not a good sort of environment for attracting investors.
Do you have any specific niche groups that's going to be at the seminar, or is everybody invited to attend?
Well, we've sent out invites to a wide range of groups, academics, researchers, government, business people. The aim is to have as wide a range of experts as possible, so that we can discuss this issue and take it further.
Did you partner with government or government NGOs, that sort of thing?
Well, the CSID basically does policy work for government. It's an organization. It's part of the School of Economics and Business Science, which does policy work for government. And we've done work for the DTI, EDD, Transnet, and several other government municipalities over the past about 10 years or so. So our niche basically is working with the government.
And what do you think now are the contributing factors to the falling rand that we have currently seen? And the Reserve Bank, as we just heard at the insert before, they are saying there's no recession in the near future.
Well, absolutely. I mean, one of the main things that would lead to currency depreciating or appreciating is demand for that currency, definitely. Demand for that currency for various reasons, whether it's to invest in that country or to demand their exports. So what has happened over the last couple of years in South Africa is that because of the strikes in the mining sector, our exports have fallen employers have lost to the tune of 9 billion already this year, which is output that would have been contributed to our exports and brought in the much desired foreign currency. So basically, that has a very negative impact on the economy. The strikes, the economic environment, all those contribute inflation towards whether a currency strengthens or weakens, basically.
Now, from the CSID perspective, what are some of the solutions to strengthen the rand as such, if any?
Well, South Africa is starting to get a bit of a reputation as a not-so-great trade partner. You know, I think it would be devastating for the economy. We need to try and do away with that kind of reputation as fast as possible. And the way to do that will be to have a stable environment where investors really feel, you know, great about investing in the country. So it's great that the new Minister of Finance is talking to various stakeholders, and let's hope that something can be agreed upon.
With our current labour regulation in place and the labour strikes that we currently have, is it scaring off investors, you think?
Well, I think that I would say yes. If you look at South Africa's foreign direct investment index of last year, South Africa fell about 2 places last year. They've recovered a bit this year. The strikes last year were also really bad for the economy. So I think that for a country that is really at the crossroads, struggling to attract investment, these strikes are definitely not great for the economy. I think a very stable environment will do a lot of good going forward for the economy, so, especially if we are to achieve the growth rates proposed by our National Development Plan, creating 5 million jobs by the year 2020 and growing at about 6 to 7%. We have gone backwards in the last quarter, and the economy contracted by 0.6%. We should be going forward, not backwards.
So your ideas, basically, in terms of industrialization, is in tandem with the National Development Plan, it seems, in terms of the infrastructure development.
Well, I think that if you look at from 2007, the government changed course and started focusing on industrial policy, targeting various sectors and providing support for industry with the National Industrial Development Plan of 2007. IPAP 1 and IPAP 2 have followed, which further provide support for the industry. The National Development Plan reflects the new growth path, the IPAP, as well as the National Infrastructure Plan. So I think that there is coherence in these programs going forward. I think there's some really great things in the NDP in terms of support for the industry and small businesses.
Gerald, thank you so much for joining us here in studio,
Thanks,
coming to AM Live. Yeah. That was the economic policy researcher at Wits University, Gerald Mfongeh. He's talking to us about a seminar that will take place at Wits on the 12th of June that will focus on the relationship between financialisation and the economy in South Africa.